Welcome to today's lesson. Today we continue with IAS 33 and we'll be looking at dilutions. Now, under the dilution, we have arrangement that can cause earning per share to dilute. One is convertible loan note, and then the another one is what? Share options. If you want to learn about the share options, please subscribe to my YouTube channel, and I have serialized share options with what? With practical examples. Now today we'll be looking at what? Convertible loan note. Now, convertible loan note. What is convertible loan note? Convertible loan note, they are loan arrangement with what? With creditors that they have option to what? To convert the debt to ordinary shareholders. That is the arrangement. Now, when this arrangement happens, the equity increases with no financial investment. So that is the arrangement. So you have example, you have what? Debenture holders. So you have 10%, 200,000 debentures in your what? In your account. So the arrangement is that they have option to what? To convert their debt to what? To ordinary shareholders at what? At the what? At the unit price of what? 0.2 pesos. You see, so when you give them this option, they are what? They have the liberty to what? To convert the debt to become ordinary shareholders. So when this happens, you realize that your what? The number of shares will what? When you convert this one into a shares, the number of shares will increase, right? So assuming you have this and you've arranged that they should convert this one to what become ordinary share, and you already have shares outstanding to be 500,000. What happens here? These people are creditors in your books. The moment you give them the option and they exercise that option, this is what is going to happen. So you realize that you what? Convert what? Debenture holders to what? To ordinary what? Shareholders. And then this is how it looks. So you have what? The debenture of how much? 200,000. And the unit of what? Of their conversion is how much? 0.2. So you multiply. So when you multiply, what do you have? So you will have what? 40,000 shares coming in. So you have your outstanding shares to be what? To be 500,000 plus the converted debentures, which is what? 40,000. So when you add it, what do you have? You have what? 54,000. You see, your equity number what will increase. So when this happens, what? It dilutes the what? It dilutes the basic earning per share. That is the idea of what you call dilution. Okay, so let me show you the steps of what? Of calculating to determine the dilution of what? Earning per share. So one, you'll find what you call your adjust what? Profit. How do we adjust for? You will have your what? Your net profit here. You have your net profit. Then you add loan interest. Now watch here. You add loan interest. So this is how it is. You have your debenture holders. Your debentures. The total value in debentures is how much? The value is 200,000, and then the interest that the company will pay to the debenture holders is what? 10%. So you realize that every year the company will pay 200,000 times 10% to the debenture holders, and then it will be how much? It will be 20,000 as the debenture holders. So debenture holders will receive 20,000 as interest on their on their investment, and the company will treat this interest as what? So we will come to a profit and loss extract. This interest is treated under what? Under what? Administrative or under expenses, right? So interest of what? Of 20,000. This 20,000 is what? Is tax free. It means the company will not pay tax on what? On the 20,000. So at the end of the day, when the company is preparing its financials, they will pay the debenture holders 20,000, and the company will also what? Debit this 20,000 as what? As interest in their what? In their expenses, as which form part of what? Of their expenses at the end of the account year. Now, here is the kick. Now, these debenture holders who are receiving this 20,000 as interest now want to convert to become ordinary shareholders. So if they convert to become ordinary shareholders, that means the company is no more going to pay these 20,000 to the debenture holders. Rather, the company will consolidate or will add it to their profits at the end of the accounting year. If they will add it to their profit at the end of the accounting year, this money we don't pay tax on it, because in our profit and loss account we debit it as an expenses. So in our chargeable income, this 20,000 has already been removed, so we don't pay tax on it. Now, the moment these people say that, okay, you agree to convert these people to become ordinary shareholders, then this interest that you are paying to them will no more be paid to them. The company will consolidate it, or will take this interest back. So when they take it, where does it go? You will credit to your profit. You credit it to your revenue. So when you credit to your revenue, then that means the 20,000 become automatically chargeable. It becomes automatically chargeable. So we pay tax. We will pay tax on it. So that is what you are going to see here in the formula. So you see here net profit after tax, right? Then you add loan interest. So this loan interest, as I earlier indicated here, is that we are supposed to pay it to the debenture holders, but because they decided to convert their debentures to become ordinary shareholder, this interest will no more go to them. The company will absorb it. So when they are absorbing it, you will add it to our net profit. So once we are adding it to our net profit, remember, watch here, net profit after tax. It means tax has already been taken from it. So if you are coming to add this interest to this profit, then you have to what? You have to charge tax on it. You have to charge tax on it before you add it. So you say you less tax benefit. So when you less whatever you have left, then you'll bring it here. So whatever you get is what you call adjusted profit. So now the second step is what? Convert loan note to shares. Simple. So when you are done, the third one, then you find your wins. So you'll find your wins. You bring your outstanding shares, then you add your converted debt to to this. That gives you your total wins. Let us look at this example. DK Limited net profit after tax is 6 million. Shares outstanding of the firm is 10 million. 10% debentures is 2 million. The holders of this instrument has option to convert their debt to shares at a unit price of 0.2. Tax is 25% required. Calculate basic earning per share and diluted earning per share. All right, so we'll follow the steps. So one, you calculate your basic earning per share, whereby you have what? Profit after tax less any preference dividend, all divided by what? The wins. Now, in this question, we understand that the profit after tax is what? Is 6 million, all divided by what? The shares they allotted is what? 10 million, which is 10,000. It is there. Everything is there. Okay, so we have for 0.6. Second step is what? Find the diluted earning per share. So what do you do? So this is where convertible loan note issue comes in, because it's a debt. So when you are coming to do your conversion, you start with what? Your adjusted profit. So your adjusted profit, you have your net profit after after tax. And in there, what did I say? Net profit after tax is how much? 6 million. Then you add interest on what? On loan note or on loan. So you have what? The loan is how much? 2 million, which is 2,000. At what? At an interest of what? 10%. That is what it is in there. It at the interest of what? 10%. Okay. So this gives me 200. Then I less what? Tax benefit, where you have what? 200 multiplied by tax, which is 25% times 200. So that gives me what? 50. So unless it gives you what? 150 here. So I just have it 150. So this will come out my adjusted what? Profit. So the next step is what? Is to convert loan note to shares. Now how do we do that? So you have your what? Your loan note to what? To be 2 million, 2,000. And the unit price is how much? Let's say you should convert it out to zero. Let me check. 0.2. So what do? You multiple. You have 2,000. So that gives you what? 400 shares. You come and do your what? You find your wins. On your outstanding shares, your outstanding shares is how much? Outstanding shares in the question is 10 million, which is 10,000. And then you converted your converted debt. Your converted debt is how much? 400. So when you add, you have what? 10, 400. So now you can comfortably calculate for your diluted earning per share. Where you have what? Your profit after tax less preference dividend, if any, all divided by your what? Your wins. Your preference dividend is how much? No, preference dividend, profit after tax is what? 6 million. All divided by what? Your wins. What do we have here? So what do you have? I have a 6. That gives you 0.58. Alright, so since you have your basic earning per share to 0.6, and then your diluted earning per share, is what? 0.56. It means it is what? It is dilutive, right? All right, so if it is dilutive, then when they are preparing financial statement, this is what will be what we presented in the financials. So that is it about explanation 2, and then workable example on convertible loan note.